Insider by Superstocks by Stine, I think, is one of the best relatively unknown trading books out there. What I love about the book is Jesse's combination of technicals, so looking at the chart patterns, understanding where the low risk entry points are, when are the optimal places to be selling as well, blockbuster fundamentals, what are the fundamentals that really drive a company's share price higher, and also psychology, both in terms of Jesse's own psychology, but also psychology of other market participants deduced from looking at the stock chart itself. What I'm going to do is give you an overview of Jesse Stine's methodology. I'm going to come at this from 5 main areas. Number 1 is going to be the identification stage. Number 2 is going to be controlling risk, followed by risk mitigation, followed by optimizing the profits, where we're going to get a lot and very deep into the sell rules, and then also the mindset element as well. This is what I really love about the book as well, the mindset element. I would actually recommend you pick up a copy because I think there's a lot of golden nuggets in there. As we progress throughout the presentation, you're going to see several market Smith charts, certainly when we're talking about the earnings and the sales and other fundamental data. They are today's video sponsor. There is a discounted trial available in the comments below if you are interested. And with all of that being said, let me try and get your attention on the very first slide. Well, that was the first slide, wasn't it? This is the second slide. So here we go. This is a stock that Jesse traded. So I'm going to show you 3 at the beginning and just give you an overview. I'm not expecting you to get it in these first couple of slides. Hopefully you get it by the end. So with all of these videos I do, I recommend watching them twice, because I think when you watch it back the second time, things just start sinking in. When you're trying to do a whole process like this in a video, it's lots of different pieces of the jigsaw puzzle, and I'm trying to give you all the different pieces of the jigsaw puzzle, and sometimes the way I'm explaining it, how you could be interpreting as well, they don't really fit. But I think the second time round, they should really fit together. So let me just give you a very quick overview. So technicals of boom here, very long base before the breakout. Here's your very long base before the breakout. Huge volume expansion on the breakout coming through here. Huge relative increase in the volume. Look at the volume coming through. That's terrific to see. Great angle of attack. You're going to learn all about this. Don't worry. Under $15. Breakout above the 30-week moving average. Fundamentals. Recent insider buying. Earnings winner with increasing backlog. I modeled sustainable sequential earnings increases going forward. Annualized PE of 10 upon the entry. Very easy year-over-year comps coming through, enormous operating leverage, a great earnings headline, a float of 5 million shares, conservative management, super theme of explosive bonded metal, which nobody knew anything about. Let me show you a couple more. This is Ford here. So technicals, long base before the breakout, high angle of attack, large volume expansion on the breakout. Okay, look at the volume starting to come through. Okay, massive bases that have got built, huge relative volume coming through, and then looking for the setups there afterwards. You're not going to get the setups yet. I'm just giving you an overview of some of the things you're going to be learning. Fundamentals, insider buying, annual PE of under 10, earnings winner, EPS up 700% year over year. Very easy upcoming earnings comp, great headlines, low float, super themes, yada yada yada. You're going to learn about all of this. Do not worry. Technicals. This one here is rare, so it comes out of this IPO base here. It has a high angle of attack, weekly volume expansion of 600%. So when it breaks out of this base, huge relative volume coming through in terms of some of the key fundamentals. Huge earnings, sustainable earnings with a backlog growth, annualized PE of under 10. The PE was 8 at entry, easy year over year comps. Don't worry, you're going to be learning all about this. So let's just do a little bit of an overview of Superstock. So what is a Superstock? A Superstock is blockbuster, sustainable earnings release with high operating leverage plus easy upcoming comps. Don't worry if you don't know what comps are, easy year-over-year comps, you're going to learn all about it. This video is going to be very deep in terms of psychology, fundamentals, and technicals. Huge weekly volume for us out of a strong base, sending the stock above its 30-week moving average at a high angle of attack, ideally like 45 degrees or so. Price under $15 with an annualized PE run rate of 10 or less, a low float and conservative management team. Mega bonus if there is insider buying and also a super theme. When to buy? 2 to 3 weeks after initial earnings breakout. Wait for a gap test. Don't worry, you're going to learn about that, and or low volume, narrow price range. Jesse really loves when price and volume just basically comes to a standstill in the context of an uptrend. Buy the lower trend line, especially coinciding with low volume and tight price range. Buy aggressively at the magic line. Don't worry, you're going to learn about magic lines. Ideally on the lowest recently weekly volume in a very tight weekly price range. When to sell? So we're going to go very deep in terms of different sell rules as well. So 7 to 10 weeks after a magic line thrust. And you might be like, what on earth is a magic line thrust? 9 months into an advance, parabolic surges, and then you might be like, what on earth is all of this? Weekly gaps at new highs, a weekly close below the magic line, largest weekly price range after a longer term advance, after the 4th or 5th surge off the magic line after a long advance, wide weekly price ranges, and high volume volatile trading above the magic line, especially if flattening or declining in terms of the moving average. Doesn't that all sound interesting? Right, let's get into it. So this is going to be a little bit text heavy at the start, and then I'm like, I'm not going to go text heavy because I hate just reading and reading and reading. So when there is going to be text on subsequent charts a little bit later on, then there's going to be some charts attached to it. So there's going to be some text and some charts, but just the first couple of slides, there's just going to be a little bit of text. I want to give you a little bit of an overview. So out of 15,000 stocks in the US and some 63,000 stocks worldwide, it also helps give you, I think, a bit of an insight into kind of Jesse's mindset and how he's kind of thinking about his process. My sole purpose is to discover the 1 or 2 biggest future winners that have the ultimate risk reward characteristics of undervaluation, rapid growth, solid technical base, inspiring theme, and it factor, so i.e. a super theme. All of them ideally support by recent insider buying. These special situation stocks typically have a powerful and contagious story to sell. The really big money is made while surfing the waves of the emotion generated by these game-changing stocks. Doesn't that sound like a really good video and or book? Again, as I said, I recommend the book. It's very, very good in my view. The charts convey absolutely everything. If you can't become one with a chart, there is simply no way to succeed on a massive scale in the stock market. We are seeking an undervalued stock that has the ultimate technical setup backed by world-class fundamentals. Some more quotes. The vast amount of wealth is accumulated while sitting, while waiting patiently. Didn't Livermore say something about that? A successful trader needs to develop a consistent and disciplined approach to how he selects stocks, how he enters and exits positions, and importantly, how he reacts to stock gyrations. A disciplined mind is one that doesn't react randomly to portfolio volatility. As part of the visualization process, we're even going into visualization and meditation. If one mentally rehearses both positive and negative outcomes in advance, there should be less of an emotional reaction when those outcomes come to fruition. Isn't that interesting? One more. I think it's about one more. In any period of history, high growth stocks that are significantly undervalued, undiscovered, with a contagious theme, a great chart, and ideally supported by insider buying, have proven to outperform the market by a wide margin. Blockbuster chart patterns combined with 5-star research will forever stand the test of time. Using my principles, you might be fortunate to discover 8 or 10 potential super stocks per year. Sure, you can certainly make money investing in tier 2 super stocks on a more regular basis, but the really big fish only come along once every so often. The big fish are the ones that can truly change your life. I'm going to skip ahead now because we've probably read a little bit too more. However, I will read this one because I think it's important. Low risk windows of opportunity take place when everybody has given up, not when everybody is enthusiastic. So what you're going to see when we go into the charts is Jesse is looking for stocks that are in the context of uptrends. He uses the weekly charts, but by all means you can apply this on the daily chart. Daily chart's my preferred kind of time frame for looking at things, but the weekly chart as well. And basically when there is the opposite of enthusiasm, basically when price action gets really, really tight, the volume dries up, i.e. no one is looking at the stock. So this is where Jesse is linking psychology back to actually what he's seeing on the charts. I really, really like that. A stock's only mission in life is to move higher with as few people on board as humanly possible. If you have been trading for more than 2 weeks, you probably have experienced that already. What is a super stock? So a bona fide super stock, this is the last text-heavy slide, then we're into some charts. A bona fide super stock is like a NASA, that should say, rocket. It takes a major thrust, so volume, to get it out of Earth's atmosphere. That's coming out of the initial base. But once it reaches orbit, it doesn't require much energy to keep it moving in the desired direction. This is kind of like Newtonian physics. So object in motion tends to stay in motion before being acted upon by a superior force and all that good stuff. Because of unbelievable earnings or a never-before-seen theme or catalyst, super stocks attract the market's very best traders. This is going to be a key thing as we look for kind of orderly price action as we go along as well, which is one of the things to look for. Clean charts. Super stocks attract superstar traders. This is where the creme de la creme, the best of the best, are playing. These stocks attract the smartest momentum Momo traders in the world. You will see the same group of Momo traders in the same stocks time and time again. These are the traders who live and breathe these stocks to the exclusion of all others. Through strategic purchases, these traders like to use their large bankrolls to manipulate manipulate these stocks to nosebleed levels. As super stocks are most often one-of-a-kind stocks, they act entirely independent of their sector or the market at large. Many super stocks end in parabolic runs that defy all traditional limits. However, once their bubble pops and the big money Momo traders depart, these stocks can crash and burn in a relatively short period of time. Here we go. So we're going to start off with the 8 technical super laws. So a strong base breakout. Now, I'm not going to read all of this to you because I think otherwise we'll be here forever. I'm basically just going to summarize it to you and you can read this as you go. So in essence, a strong base breakout, it's the law of cause and effect as well, okay? You're basically looking for large causes. So stocks that have basically gone sideways for many months and or many years. The bigger the base, the longer time frame there is for more accumulation by the smarter money to take place during said base, okay? So less accumulation takes place in a 2-week base relative to a 2-year base. Hopefully that kind of makes sense. You also have longer term investors that have been investing in the stock over the prior couple of years because they believe in the future fundamentals of the stock. So these long bases can mean that you have kind of long-term holders and stronger hands in the base, and all the weak hands have basically gone because they're just not interested. The share price hasn't gone anywhere for 2 years, okay? So it's the more accumulation taking place. What you would like to see is on the breakout of the big base, you'd like to see this, okay? Widespread candlesticks, so i.e. really wide on a relative basis from where it opens to where it closes, and massive volume coming through. This is the key point. Massive volume coming through tells you there is a lot of eyeballs, there's a lot of buying power on this stock. So this is kind of that NASA rocket getting up and into orbit, that initial thrust that Jesse was talking about. Look for the huge relative volume and a big base breakout from a long period of consolidation. Number 2, breakout above the 30-week moving average. And many people deem when the stock is above its 30-week moving average, you can get this from Stan Weinstein's Secrets of Profiting in Bull or Bear Markets as well. You'd like the stock to be above its 30-week moving average. So with Ford here, don't worry about kind of all the technicals and stuff like this. I'm trying to, like as the book does, break it down into component parts, give you lots of pieces of the jigsaw, and by the end of the video, we've pieced all the pieces of the jigsaw puzzle together, and then you're looking at a nice, pretty jigsaw, if that analogy works. So here you can see the big base building, and then look at the volume coming through very, very early on. This is the thrust. This is kind of getting the momentum into the stock. So big weekly price spreads, huge relative volume coming through is what you want to see. If you're wondering what this is down here, this is a relative strength line. The blue dots indicate 52-week highs. That's a free tool. Search my name on TradingView in the indicators and you will find it. Number 2, volume expansion. An essential feature of all super stocks is extreme volume expansion at the initial breakout, as we've just been talking about. This surge in volume is best seen on the weekly chart. The best stocks exhibit lackluster volume for extended periods of time during their base building. When the great news hits, signaling dramatically improved present or future fundamentals, volume will typically expand 500 to 5,000%. So with these phase 1 bases, is when the stock comes out of the base, this could be kind of those blockbuster fundamentals coming out. The company's earnings are up 200%, 500%, 1,000%. Revenue, so sales are up 100%, 500%, whatever it may be, but like a catalyst has changed. Something has changed of this company to potentially start propelling it higher. High angle of attack. This is kind of a visual one to be looking for, but basically the best stocks will attack, i.e. trend up at around about a 45-degree angle. So a lot of the charts that you're going to see, just remember that, like 45-degree angle of attack. When the stock then starts kind of like losing that momentum, losing that angle of attack, and starts like sloping over like this, and if it starts getting a little bit longer in the tooth, i.e. it's been trending for say over 6 or 9 months, then it can be a sign of waning momentum. But when they're coming out of the bases and those initial base breakouts that are happening, 45-degree angle of attack. This here, if you look at the black line here, this is the 10-week moving average. So see how it's just trending up here, high angle of attack, around about 45 degrees. Then it starts kind of waning here and rolling back over. Just something visually to train your eyes for as we go. Another example of high angle of attack. Okay, you can see these moving averages moving up. It's actually the same stock. They're around about 12 years apart, so it looks pretty similar. Cup and handle, breakout, high angle of attack going on here. Okay, here, cup and handle, it's a low handle here. Breakout, nice high angle of attack, and see the multiple bounces off the 10-week moving average. We're going to be talking about that a little bit later as well. Under $15, so this is an interesting one. The absolute sweet spot for maximum percentage move tend to be, in terms of like the initial breakout early on in the stock's move, in the $4 to $10 area for an initial low risk entry. in rare instances, I will consider a stock under $4, but I'm generally highly skeptical as the lowest price stocks tend to have negative cash flow, shoddy accounting practices, or repeatedly dilute shareholders. So interesting. This is near here. It's a Chinese EV stock. When it broke out of this multi-month base here, interesting that the share price was $4.20, then it went up around about 1,200%. So Jesse will be looking for those lower price stocks. So many of you may be familiar with, say, William O'Neill's teaching. Jesse in his book actually highly recommends William O'Neill's book, How to Make Money in Stocks, as the #1 book to be reading. But Jesse does things a little bit differently, kind of understands the principles, but it's done things a little bit differently. So O'Neill will be looking for the higher price stocks. Jesse is actually looking for the lower price stocks that have the blockbuster fundamentals coming through. Let's go on again. A nice clean chart. This is something that you're going to have to train your eyes to. So this here is a really nice chart. The best way for me to basically explain this is to show you a really nice chart and a terrible chart. So I'm going to go forward one slide. This here is not a clean chart. This is a daily chart. It's OCEA. Now it's around about a $7 stock or so. It's relatively new. It's a SPAC here. This is the daily chart. Do you see how it's just all over the place? It's not orderly. It's just erratic. There's nothing predictable about this chart. It spikes up hundreds of percent, comes down, spikes up, comes down, spikes up, comes down, spikes. It's not orderly. It's not smooth how the stock is acting. So you want to see something like this. So this is Axon here. See how it just builds this nice phase 1 base, and then this is on the 1 week chart, the weekly chart. See how it just moves up here, and then the pullbacks. It's the pullbacks what you're really looking for. See how it just pulls back in, and I like using candlesticks, so it's tight candlesticks, and it just pulls in very orderly. There's nothing overly erratic about this stock, how it's acting. So stocks, it sounds a little bit woo-woo, but stocks have personality. So some can just be very kind of orderly in terms of how they move. Others can be very, very erratic. So what Jesse's saying is nice clean charts, orderly in nature, are those that are preferred. Let's go forward. Prior momentum, prior super stock. So this is, again, going back to the personality of the stock. Has the stock been a big momentum mover in the past? Lightning can definitely strike twice because the former momentum stock was widely known throughout the trading community in the past. Its resurgence can happen in the blink of an eye as word spread. This is also just understanding the behavior of the stocks as well. Stocks will tend to exhibit repeatable behavior characteristics. So some, as I was just showing you with OCEA, this stock is highly erratic. It spikes. It's so basically pump and dump. Right? Pump, dump, pump, dump, pump, dump, pump, dump. So you've had one pump, here's another pump, here's another pump, here's another pump, 4 pumps already. So it's more reasonable to expect that there's going to be a 6th, a 7th, an 8th, a 9th, a 10th pumping up along the way. So you're looking for the stocks that actually have a history of acting how you want them to act. So i.e. a stock that can go up a couple 1,000%, or maybe it's 500% or something like that, but acts well, builds the bases, builds the setups, and then in terms of the management rules that we're going to go on to, meet your management rules. So the trade management standpoint is very, very, very important, I think, and Jesse thinks. Number 8, is the stock acting like a super stock? Is it respecting its magic lines? So let's talk a little bit about magic lines. Once a stock is broken out of its base and has been trading for several weeks, is it acting like a blockbuster stock should? Has the stock's average volume increased since it broke out of its base? The best stocks will hit their magic line and make highs 4 to 6 times before their run ends. All stocks have different personalities. It makes perfect sense that some would have different magic lines. The secret is to fit the moving average to the stock. So Jesse talks about magic lines. So the magic line, kind of the Mac Daddy of magic lines, is the 10-week simple moving average. That's going to be very closely aligned with the 50-day moving average on the daily chart. So this is eBay here back in the early noughties. So eBay builds a big base. Those of you who studied Minervini's work will know it's got a little bit of a kind of VCP to it, right? Price starts tightening from left to right, building higher lows. That is a sign of absorption of supply, of accumulation going on. Then when it breaks out, pay attention to this black line here. See how it has 1 bounce, 2 bounce, 3 bounce, 4 bounce, and then breaks it over here. This is Jesse point, 4 to 6 times before their run ends. So the magic line, start with the 10-week, but you can then play around with it because maybe it's the 8-week, maybe it's the 12-week, maybe it's the 15-week. You're basically trying to find a moving average that fits really nicely. For me personally, I don't do that. I like to keep my moving averages the same on all charts. So throughout the charts, you're going to see, other than maybe 1 or 2, I've just kept it as these weekly moving averages you see here. The 21 weekly EMA, I just like that one. The 40-week moving average, that's going to be very closely aligned with a 200-day moving average, but you can kind of, I'd be a little bit aware of like data mining. So like trying to fit it too perfectly. You can play around with it. I just like using the 10-week moving average on my chart. Now let's go into, so we're covering some of the technicals there. Let's go into the Dirty Dozen fundamental super laws. So here we are now on the MarketSmith charts, and I will show you a couple of things. So earnings winner, this is the number one ingredient for the ultimate monster stock. For world-class momentum, we are looking for a situation where a company has consistently reported quarterly revenue and earnings per share that have not deviated significantly from each other over the past few quarters. What we want is a company that has a lump track record where revenue and earnings jump up and down from quarter to quarter. What we don't want, is a lumpy track record. So they're kind of really good earnings, then they're terrible earnings, then there's really good sales, and there's terrible sales. You want to see that sequential growth ideally. Once we have established that the company's results have been relatively consistent over time, we want to see revenue and or earnings per share, more important than revenue, in the most recent quarter jump significantly higher than the previous quarter. So like a real breakout coming through in terms of the earnings. Many investors will assume that a monster quarter is a one-time event. Because of this thinking, investors don't initially bid the stock up in line with its newly improved fundamentals. So this is a stock which just came up on some of my screens. It's relatively recent at the time of filming this one. So you can see here, you see on the daily chart, earnings come out and it's plus 999%. So in terms of the earning, the company on a quarterly basis reported 13 cents versus for the same quarter on the prior year, so it's year over year, that takes out the seasonality, 1 cent. So it's absolutely huge. It's up more, it's quadruple digits, right? MarketSmith only goes up to 999%. The revenue, relatively unchanged, 8.7 million versus 8.6 million, but the after-tax margins were up to plus 16.1. So even better. I'll show you a chart of Monster Beverages a little bit later. When you have the earnings growth, the revenue growth, and the margins growth as well, including, you can think about operating leverage to that as well. And then in the most recently reported quarter, see how you get this really good reaction coming through here. So earnings are plus 444%. So the company just reported 27 cents per share versus the same period the year before, so year over year, 5 cents. And this time you've had an acceleration in the revenue. So 10 million have been reported in the most recently reported quarter versus 6.8 million for the same quarter a year ago. That's a 49% increase. And then take a look at the margins, now going up, the after-tax margins to 29.4%. And then we take a look over here at the guidance. So the yearly earnings per share to come in this year are now 45 cents plus 150%. And these little green arrows mean the forward guidance is up. 2024, 48 cents a share. So that's 7% with the guidance coming up as well. And then if you take a look here at the EPS on a year-over-year basis, see how they've basically gone from losing money 19 cents, 25 cents, 18 cents, 45 cents. Like that's a real game changer. And then look at the earnings starting to come through. Really, really, really interesting. Let's go into another one. So we're now on to number 2. Are the earnings sustainable? The most important question to answer is whether or not this new level is earnings is sustainable. To help answer this question, we must ask, has the company recently started selling a new product or a new product line? Has the company embarked on a sustainable cost-cutting / profitability incentive? Does the company have new customers? Has the company recently discounted an unprofitable division? Is there a new industry-wide catalyst affecting sales and profitability? I think artificial intelligence at the minute. Has the company recently merged with another company whose earnings are just starting to hit the bottom line? Buried somewhere in the quarterly earnings statement, management will often explicitly state that revenue and earnings will continue to grow over the next several quarters. So if we take a look here, this is Palantir, PLTR is the ticker. So if we take a look here, you've had some really good reactions to the earnings coming through, and now the earnings coming through plus 100%, plus 150%, and then you also have sequential growth in the revenue as well. So 8 quarters ago, the reported revenue was 375 million, then it was 392 million, a couple quarters later, 473 million, 508 million, 525 million. Take a look at the estimates this year, plus 252% with the guidance up. Next year, plus 14% with the guidance up, and that's a real step change. So in terms of the yearly earnings per share that's being reported, so the company goes losing money, 8 cents, 13 cents, 6 cents, 21 cents. Like a real game changer there. And then the earnings are coming through as well. And obviously Palantir is involved in artificial intelligence. So very interesting there. Next one. Are annualized PE of less of 10 or less? So what Jesse is basically looking for is a stock that has a low valuation, so a PE ideally of less than 10. So it's interesting. I think if you go and look at, say, Nvidia, which is like the institutional stock, I think the PE at the minute I think is like over 100, maybe over 150. But what Jesse is actually looking for is stocks that are high growth stocks in terms of suddenly the earnings and the sales coming through, but are extremely undervalued. So that's what he's looking for. He's looking for blockbuster fundamentals in a undervalued growth stock that is preferably a small cap stock instead of a large or a mega cap stock. So if we take a look here, this is ALB. Now this one here, this is a large cap stock. It's 27 million. I was trying to find good stocks to kind of help highlight some parts. So albeit the market cap is way too big for a stock that Jesse would be looking at, he would be looking much more at small cap stocks. But if I just show you here, PE of 10 or less, so the PE for ALB at the minute is 8. So it is less than 10. But then if you take a look at the earnings coming through for this stock, well, the last 1, 2, 3, 4, 5 quarters have been triple digit earnings. And if you take a look at the earnings per share that have been reported on a quarterly basis, look at the acceleration here. 89 cents, $1, $2.38, $3.45, $7.50, $8.62, $10.32. Then take a look at the sales. So 8 quarters ago, the company was reporting on a quarterly basis 773 million. In the most recently reported quarter, they've just reported 2.5 billion. So from 773 million to 2.5 billion. That there is a huge change. Now, obviously, the stock is chopping around all over the place, but imagine if those fundamentals were coming out. That's why I drew these lines. Imagine if those fundamentals in terms of this PE as well was reported when the stock was trying to come out of this flag type base here. Interesting, right? Let's go on to another one because you probably now have time to read that yourself. So sequential improvement. Along the same lines as sustainability, ideally, you want a company whose revenue and earnings are increasing every quarter. You want to find the stock after its first big breakout quarter, but there may also be significant upside in subsequent quarters. That's what Jesse was saying a couple of slides ago about a monster earnings report, and people just think, it's just going to be a one and done. But then the company can announce subsequent kind of monster earnings report and smash expectations. After the second quarter of earnings growth, investors become more comfortable with the earnings trajectory and generally bid the stock up to a higher multiple of earnings. After a few quarters of increasing earnings, investors become very confident in the earnings sustainability and can drive a stock's annualized PE well above 30. So this is a hypothetical example. You see some of these a little bit later on as well. So this is for VTSI. So if you take a look here, in terms of the quarterly earnings per share, the company has gone from, reporting 5 cents, 12 cents, a cent, 5 cents, 7 cents, losing 7 cents, 13 cents, 27 cents. Like a massive change there. If we look at the sales coming through, 5 million, 6 million, 8 million, 6 million, 8 million, 4 million, 8.7 million, 10 million. Like a huge step change there in terms of 27 cents being reported, and the sales are coming through as well. The sales have basically doubled versus 8 quarters ago. That's really good. Then you've had some really positive reactions coming through, and look at the volume and look at the positive price action coming through. So what Jesse would then do here is go, well, if this company can continue to report 27 cents per quarter in subsequent quarters, so times the 27 cents by 4 quarters, that would be a $1.08 annualized earnings per share coming through. So this here, the estimates currently for 2023 are 45 cents a share, and next year is 48 cents a share. But what if it comes in at $1 rate? That's his point. And then if you go and put a 30p multiple on that, so you times the $1.08 by the 30p multiple, that would then be a share price of $32.40. Interesting. It's currently an $8 stock. You'll see some that he did this with a I think I may have already showed you it actually earlier on in the video. I think it may have been Ford Industries that actually got to a $72 price target, but really interesting stuff. So anyway, that's one way of Jesse looking at it. Another one, easy earnings comparison. So a lot of it is psychology. So I will read this one out to you because I think it's actually worth doing. So one of the worst things that can happen to a stock is for it to run into difficult year over year. So that's Y over Y revenue and earnings comparison. So this is called easy comps or hard comps. If a stock posts 25 cents earnings per share versus 5 cents for the same quarter a year ago, so that's then year over year, it's up 500% a year earlier. The chances are good it will perform very well. But what happens if the company posts 25 cents again the next quarter, but the earnings were 27 cents a year earlier? its year-over-year earnings comparison would be negative. We ideally want to look for stocks that are posting substantial year-over-year earnings growth. Apology about the typos. I have dyslexia. I struggle with typing things. Also talking as well. Before purchasing a stock, we need to look at the next quarter to see if it has easy upcoming comps versus the prior quarter. This all then feeds into headlines as well. So investors in this instance here, if we believe the company will post 36 cents earnings per share next quarters versus 3 cents in the year earlier period, the stage is set for the stock to become a huge gainer. 36 cents versus 3 cents is going to make one heck of an earnings report headlines. Investors will see stock X reports 1,200% earnings growth. So if you take a look here for this stock, which is VIST, so you see here, this stock's actually going to start running into, and this is with a lot of these oil and gas stocks, is they're actually going to start, even though most of them trade on like just ridiculously low PEs. The stock still trades on a PE of 6. But you see here how the earnings that have been coming through are, in the last 8 quarters, they've been triple digits coming through. So it's going to be quite hard for a stock to keep up triple digits earnings per share growth. So what Jesse's saying is when the year-over-year comparisons are negative. So if I go back to VTSI, so there's a lot of VTI and S's, aren't there? But with this stock here, if you see the next couple of quarters that it's going to be going up against, so it's just reported 13 cents and 27 cents. So it's going to be coming up against not too difficult comparisons. You've got 5 cents, you've got 7 cents, and you've also got negative 7 cents coming through as well. So these are much easier year-over-year comparisons. So then you can get those blockbuster headlines that company ABC reports revenue up 300%, 500%, 1,000%, whatever it may be, rather than negative 5%, negative 20%. Like, it doesn't grab kind of the Momo traders, the momentum traders kind of real appetite. So when you see a company that's reported consistently over the last 4, 6, 8 quarters, triple digit earnings coming through, they can be running into some pretty difficult year-over-year comps. Next one here, high operating leverage and increasing margins, and also increasing backlog. I will let you read about those while I just talk you through the Monster Beverage chart here. So this is on the monthly chart. Now this stock here builds a really nice base. Look at the relative strength that comes through in the early noughties. This was during the early noughties bear market, and it builds in terms of chart patterns. Those of you that are kind of much more kind of chart pattern focused, what chart pattern do you see? I see a really nice VCP, so a volatility contraction pattern. Generally speaking, you have 1 contraction, 2 contraction, 3 contraction, and then price gets really, really tight, and you're going to see this tightness in price and low relative volume tells you there ain't much supply coming to the market, and kind of people aren't really focused on it. So Jesse, in terms of actually on a weekly chart, would be looking for this type of bar in the context of a stock in an uptrend, which you are going to learn about. But here it breaks out and the stock runs up around about 9,000%, just under in 35 months, without one close below. This is the monthly 10 EMA. I really like it. So simple. See how it just basically rides, and then you get this change of character coming through up here. And we're going to talk about sell rules a little bit later on in terms of extended above upper trend channels, but also if you start thinking the stock gets extended, lower the bar, lower the bar, lower the bar, lower the bar. But here you go, this is the yearly number. So the earnings per share for Monster Beverage in 2003, the EPS was plus 75%, the sales were plus 20%, and the net profit margins had improved from 3.3% to 5.4%. In 2004, earnings grew at 214%, sales at 63%, and the net profit margins improved again from 5.4% to 11.3%. 2005, so here you go, 2003, 2004, 2005, sales were up again 195%. Earnings were up 195%, sales up 93%, and the net profit margins another acceleration from 11.3% to 18%. So when you have fantastic technical action with the blockbuster fundamentals and improving margins coming through, you can have an almighty thing on your hands. Another one here. So this is number 8, open market insider buying. They, insiders, buy shares for one reason and one reason only. They believe that the price of their stock will increase in the future. Their buying is sending a clear signal that there just might be a major fundamental catalyst on the horizon. Not only is insider buying an indication of future fundamental success at the company level, but it also promotes significantly higher levels of investor confidence in the stock. Our goal is to find open market purchases by multiple C-level executives or directors. I find that insider buying is most effective when the insider buying takes place either during a long base building period or just after the initial breakout. If a stock is climbing out of its base and insiders continue to wrestle for shares at higher prices in the open market, there's a good chance spectacular things are going to happen down the road. We want to see that the size of the purchases are large in relation to the executive salary. There are free resources out there like setform4.com that you can go and use to find insider buying. But this one here, this is one from 2022 into 2023. So here you have a huge relative volume coming through. Look at the volume standing out. So a lot of the charts that you're going to see, there is massive volume. That's a really key component here. Massive relative volume with positive price appreciation, and then the base builds, and then the tightness comes through. So this is on the daily chart here. So here you have the CEO buying, the CFO buying, you have a director buying, you have the presidents of science and technology buying, you have a director buying, you then have the CEO kind of topping up. The next day as well only buys 10k, but the prior day was buying 141k in the open market. And then you build this cup and handle type pattern. Then look at the tightness. This is something that you're going to see for the entries. Look at the tightness and look how the volume dries up. Now this is obviously on the daily chart instead of a weekly chart, but if this was on the weekly chart, and this black line instead of being the 10 EMA on the daily chart was say the 10-week moving average on the weekly chart, that would still be a ridiculously good setup. Then before it closes below its 21-day EMA, the stock goes up about 444%. Not bad, right? So insider buying. So when you see insider buying with really positive price action and then a really nice base building, and preferably there are blockbuster fundamentals coming out, you can have a special situation on your hand. Low float and low market cap. So if your $5 Superstock has a float of just 4 million shares, it may only take $1 million or so in buying pressure to move it 20% higher. When hedge funds and momentum traders latch onto these low float stocks, they skillfully accumulate their positions at low prices without disturbing the market. Through additional buying pressure and thoughtfully placed news leaks, they can take full advantage of the low float to manipulate these stocks higher to their target prices. It is also vitally important to take a look at the average volume in relation to the float. If the float is 7 million shares while the average daily volume is 50,000 shares, chances are that the stock won't move very much until a surge in volume shows up. On the other hand, if the float is 4 million and the average daily volume is 800,000, the available float will be eaten up in no time. The best performing stocks generally have floats under 10 million shares. In my experience, the biggest movers had floats of 4 to 8 million. Additionally, most of my biggest gainers started their advances with market capitalizations under 100 million. There are plenty of exceptions, but it isn't too difficult for momentum traders to propel a $50 million market cap to $200 to $300 million market cap over the course of a few quarters. Now, obviously, if you're playing in the smaller cap land and it's less liquid, you are going to run into issues with wider spread. So yes, low floats and kind of less daily dollar volume can work for you. It can also work against you, and these things can come crashing down pretty darn quickly. So a caveat there. So this one here, this is ELTK, the ticker. It's just one that came up on some of my scans. So the market cap, 64 million. The shares in float, absolutely tiny, 1.6 million. Take a look here at the estimates for this year, plus 71% with the guidance up, and then take a look here. The earnings per share in the most recently reported quarter, 145% increase, and then you have the sales growing as well, 10 million, 10 million, 11 million. But look at the volume coming through. Huge volume in reaction to the earnings, and then just basically following up day after day after day up with a 99 RS comp rating, which is pretty darn good. Number 10, 11, and 12 are all on this one. So the it factor, a super theme. So if you think at the minute now, so themes change, right? But at the minute, kind of a super theme at the minute is artificial intelligence. So if you suddenly see a lot of stocks from specific kind of groups that are acting well, and it's all kind of into this super theme, AI being one of them, a lot of the AI stocks have been absolutely ripping. So it's trying to understand the theme that the market likes. Sometimes it's crypto stocks, sometimes it's electric vehicles, sometimes it's solar stocks, sometimes it's artificial intelligence stocks. And there's going to be new super themes that we haven't even heard of, that haven't been created yet. So trying to stay dialed into, okay, what are the potential themes? So if you look here, this is EVLV, provides AI-based touchless security screening systems that offer weapons detection and identity verification. Now, no earnings coming through, but look at the sales, how they're accelerating. 8 quarters ago, 4 million, then 8 million, 6 million, 8 million, 9 million, 16 million, 20 million, 18 million. That's interesting. Coming out of this phase 1 base here, look at the positive price action as it comes out. Look at the volume coming through. Conservative management. So Jesse doesn't like management. They're kind of hyping it up, and we've got the next $1 billion product on our hand. He just likes really conservative management to be in place. Simple, impressive blockbuster earnings release headlines. So a super stock should have a quarterly report that is both impressive and easy for the average investor to understand. A simple headline such as XYZ Corp announces revenue growth of 50% and earnings per share growth of 400% really grabs the attention of Wall Street. Going on to the next one. So Low risk entry super lots. So now we're going a little bit into some of the entries. So buy the magic line hand over fist. A majority of a Superstocks, that should say, ultimate gains take place in the first few weeks after a brush with its magic line, again near the 10-week moving average in most cases. I've just kept, for the purpose of just keeping it the same, I've just kept for the weekly chart, it's the same moving average. So the black line is going to be the one to most closely focus on, which is the 10-week simple moving average. The magic line is the ultimate low risk entry point. This magic line is typically where smart money institutions set up camp to accumulate. As the stock price and its magic line slowly converge, multi-billion-dollar institutional trading departments are busy behind the scenes buying as many shares as they possibly can without disturbing the share price. Once they finish accumulating their positions and all the magic line meets the share price, they then set the fireworks in motion. They strategically buy large blocks of shares to move the stock higher, which attracts momentum traders to get the ball rolling. Their other course of action is to tell their contacts at the company whose stock is being accumulated that that the time is right to release that press release they've been sitting on for the past several weeks. I've noticed that meaningful corporate news is usually timed to be released precisely when the technical conditions are right for a large surge in the stock price. As the stock hits the magic line, an alternative course of action for an institution is to contact its sources in the mass media to spread positive rumors or position news about the company. So if you take a look at Nvidia here, okay, breaks out of this quasi kind of cup and handle type pattern. But the point of this chart here is you see the black line, that's the 10-week simple moving average. Bounce, 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 bounce. And then here it breaks. Bounce, 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 decisive break. So it's understanding when it's bouncing, when it's decisive breaks. But you will see kind of the leaders, the like true market leader stocks, even obviously like the smaller cap stocks that Jesse is more focused on. But with the Nvidias, like the real quality kind of Can, Slim, O'Neill type stocks, you will see them supported multiple times around their 10-week moving average, which is the 50-day moving average on the daily chart, around about 4 to 6 times during their runs, and then they kind of base out and consolidate again. Hopefully that there makes sense. So if you look at Nvidia here, builds this decent sized base, that's from around about November 2016, then breaks out in May of 2017, so it's a multi-month base. Look how tight it gets. Look at the price action coming through. This is what Jesse really looks for, and you're going to learn about. Buy light and tight, as he says. See the tightness, see how the volume dries up, and then how many bounces does Nvidia have off its 10-week? Well, it has 1, it has 2, it has 3, it has 4. It basically has 5 touches, and then the decisive break on volume. Then the stock goes and rebases. Number 2, buy light and tight, as we were just talking about. So this has proven to be one of the best low risk indicators for me. At the tail end of a constructive multi-week base building period, a super stock will tend to move in a very tight band on relatively light weekly volume compared to prior weeks. After large weekly advances on accelerating volume, great stocks will rest or decline for several weeks in a row. It is only after volume declines dramatically that traders will forget about a stock. This is exactly what we want to see. The best low risk entry points are when the stock apparently goes absolutely nowhere for 1 to 3 weeks on very little volume when compared to prior weeks. We also want to see several weekly closes right at the same price, so tight closes within the same range. Furthermore, if we see a BLT setup taking place on a stock's magic line, which again is going to be around about the 10-week simple moving average on the weekly chart, it usually means that it is time to get out the big guns for a major advance. Remember that quiet trading usually means low risk. So if you see here, as the stock is building a base, I've just pointed to where price is getting tight around the 10-week moving average. So seeing here, stock basically, again, kind of VCP nature, cup and handle nature in the second half of this base. 1 contraction, 2 contraction. Then it goes and gets really, really tight in here. This is actually an inside week before it breaks out. Then the stock pulls in to the 10 weeks. So this is the magic line here. Pulls in here. Then it builds a decent sized base. See the tightness in price. See how the volume dries up. And then the trend that goes through. And then see how the stock gets supported on the 10 week, on the 10 week, on the 10 week. Then a very decisive break here. This was actually on earnings for Crocs as well. And then it just gets absolutely walloped from about $75 down to $11. And it kept going down, 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 down. Buy early in a stock's advance. We always want to buy a stock early in its advance after its initial breakout from a long base. The average high quality momentum stock will have a 9 to 12 month advance out of its base. This is ticker MT. So here's the original base. So see how it builds a nice big base. This is the causality point, big bases, and then the stock starts trending up. Then I've just pointed to multiple times where it's like it's buy light and tight, right? So you see here where these arrows I'm pointing to, like this one here, I think this is probably this one here, and I think this one here is probably the best setups on the chart. This one here is probably the best setup on the chart. See how orderly the pullback is. Look how tight it is. Look how the volume dries up. That is what you are basically looking for. Then do you see up here, I'm getting ahead of myself a little bit. We'll cover this in sell rules. See how the stock then starts acting differently. You have large red weekly volume bars coming through with negative price action. Prices opening near the high of the week, it's closing near the low of the week, it's violating the 10-week moving average pretty significantly. See how it's just acting differently. Then a little bit of common sense, the stock has now been trading or trending higher from this original base breakout since what's that, early 2003, and now we're into early-ish 2005, nearly 2 years, certainly 18 months, pushing over 20 months there. Like a little bit of common sense, this stock has come a very, very long way indeed. It's maybe getting a little bit too obvious. Number 4, buy the gap. So after a substantial earnings surprise, most super stocks will gap up and trade well above the previous day's close. Traders call this a breakaway gap or an earnings gap. The stock's fundamentals have dramatically improved since the release of the earnings. This gap will be steadfastly defended under normal circumstances by the smart money anytime the share price approaches this zone of support. In order to enter the position with the least amount of risk, we would love to see the stock retest its breakout gap. In an ideal scenario, after a surge over several days, we then want to see the stock completely demoralize the early longs as it trades down to its gap support area. This is precisely the point at which the early cheerleaders will dump their shares. Succumbing to their fear, they will assume that their investment thesis was all wrong. This is exactly where we want to be patiently waiting for our initial entry. So what Jesse is saying there is look for stocks that build large bases, gap out of the base on the back of a significant earnings report. So earnings up 500%, revenue up 100%, whatever it may be, signing of a new agreement or collaboration or something, but ideally the earnings are there, the sales are there, and it's a real kind of game changer, a monster earnings report, and it's coming out of a base. Then what he's saying is price can then sometimes pull down and undercut the low of the earnings gap bar. So you see this bar here, see the range. Here's the low of the day, here's the high of the day, and then here. See how it just undercuts it. I just call it a shakeout demand tail because it just shake out, it's a little tail, and then reverses high. So what Jesse's saying is he would then be looking for an entry around here, just as it kind of undercuts the low of the breakout gap up a day, when kind of the longs that bought it probably place their stops right there at the lower of the day of the earnings gap, and then it just knocks them out and then reverses. Remember, a stock is trying to go higher with the least amount of people on board. Next one here. So number 5, buy. Wait 2 to 3 weeks after the monster earnings. So I have found many of the biggest winners provide excellent low risk entries 2 to 3 weeks after their breakout earnings announcement. After the initial earnings euphoria wears off, the dumb money tends to move on to the next hot stocks. As enthusiasm wanes, super stocks tend to settle down for a couple of weeks while volume steadily declines. There is often a great low risk entry 2 to 3 weeks after the breakout gap. So here's Tesla. See how it builds a big multi-month base, okay? From around about July, August, it goes sideways and then breaks out in late-ish October. So look at the volume coming through. Again, this is Tesla. This isn't a small cap, this is a large mega cap stock. So look at the volume coming through. This is institutions. This is not retail doing this. And then do you see how this is something to train your eyes for, train your pattern recognition for? Multiple tight candlesticks on declining volume is a sign of absorption of supply. And you just see how orderly price is moving. Really orderly price action like this often means that the smartest Momo players, kind of the really smart institutions, are there playing around with the stock. So see how it then pulls back into its 10, not its 10, well it does pull into its 10 here, but it's 21 EMA on the daily chart. And then see how you get this nice tight price action, and look how the volume dries up. So tightness and low volume, and stock finds support around its 21-day EMA. So look at the tightness coming through. And then see this is like kind of blow off euphoria coming through up here. We're going to talk about sell rules a little bit later on. But on the earnings coming through here, in terms of actually think about Tesla and kind of blockbuster earnings coming through, there was a surprise of 542%. So the estimate was actually Tesla was going to lose money, but Tesla didn't lose money. Tesla actually reported a profit. So really kind of catching people off guard, potentially, certainly the larger institutions. So again, the market is the most Bayesian thing out there. The market will react to new information like that. This one here, buy the lower trend line. So during the months following a breakout, great stocks will make higher highs and higher lows as they advance. They will trade within upper and lower trend line or a channel. As breakout traders are buying high risk breakouts at the upper trend line, you want to position yourself mentally for a possible low risk entry at the lower trend line. Of course, the more often a stock tests its lower trend line, the more likely it is to break below it. The best stocks will make infrequent trips to their lower trend lines. During their big runs, the best stocks might test their lower trend line 4 or 6 times before things head south. Now, I'm going to kind of throw my own kind of caveat in here. Personally, I always think it's easier looking in hindsight, but in real time, it's much more difficult and subjective. Charts can also, in terms of the charts, whether you're using logarithmic or arithmetic, can look very different. So you see here, this is tarot on the weekly chart. See how you get, this is on log scaling, so logarithmic. See how it's just really orderly, kind of pulls back, bounces, just basically riding its 10-week moving average up here, right? If I go to arithmetic, these same 3 anchor points, see how it looks completely different. This is the same chart with the same 3 anchor points here, here, and here. Do you see how different that looks in terms of the trend channel? It looks very, very different. So I think it is fairly kind of subjective, that one. That's just my 2 cents on it. Next, identify. So other low risk moving averages. There are a few standard moving averages that may serve to provide low risk support. When a superstock moves out of its current base to a new higher base, there's a good chance that it will bounce off its 10-day moving average along the way. Now for me and my charts, when I'm even doing these videos, I like to keep my moving averages the same. So mine is not the 10 simple moving average, it's the 10 exponential moving average, so EMA. When a superstock moves out of its current base to a new higher base, there's a good chance it will bounce off its 10-day moving average along the way. If you feel that a stock is going much higher in a very short period of time, this is often a great place for an entry, especially if it coincides with a lower trend line. So this is overstock. See how it breaks out again, kind of like a VCP type pattern. 1 contraction, 2 contraction. Look at the tightness coming through. So tight. Look how the volume dries up, and then bounce, and then decisive break coming through here. Once a stock 10-day moving average stops working as support, the next moving average of interest is the 20-day moving average, but mine is the 21-day EMA. So the blue one is the EMA, and I'm going to teach you something about the stair step, which Jesse says is the most powerful pattern in existence. The next moving average of interest is the 20-day moving average. 20-day, 21 EMA, they're pretty much in the same places. I wouldn't get too worried about it. A strong 20-day moving average trend can last a few months after a stock's initial breakout. Beyond that, a stock will typically trade below its 20-day moving average and wait for its 50-day moving average, which is the purple line on my charts, to catch up. Notice the stair step case as it steps trends up. This is the most powerful pattern in existence. So when Jesse in the book, which was on page 120, was talking about the staircase pattern, and he called this the most powerful pattern in existence. So he was referring to Goldfield Corp, ticker GV. Is not around, it's delisted now, probably got acquired, in his book on page 20 where he mentions staircases. So I've used Celsius to illustrate the staircase hugger pattern, which he calls it, which he says is the most powerful pattern in existence. So do you see how here Celsius builds this phase 1 base coming through, breaks out, look at the volume, and then it just goes like a staircase, right? It goes up, here's a step, goes up, here's a step, goes up. Did you get it? Like it looks like a staircase, right? And then the breakouts are on volume, And you see how I'll come back to this stock in a minute. But you see here, this is another kind of staircase hugger. The stock is now delisted, this one from my kind of model database that I have. But do you see how it goes up, builds a step, goes up, build a step? So it's like a staircase going higher, right? Do you see how orderly the pullbacks are? And look at the tightness in price. Look at the volume drying up. Like this is, train your eyes to this. Like this is ridiculously good. Here is another one. This is BIOL. So see how it looks like a staircase. It goes up, it goes sideways and pulls in. It goes up, it goes sideways and pulls in. And the respected as for key moving averages, in particular the 21 EMA on the daily chart. Look at the tightness. Look how the volume dries up. So if I go back to Celsius, see how it's like a staircase. Goes up, goes sideways, goes up, goes sideways, and it just pulls into the key moving averages. That's really nice. And the blue arrows are indicating bounces off of the 21 EMA. AMD. By far the safest moving average entry point is the 50-day or the 10-week moving average. After a month or 2 of advance, most of the strongest stocks simply run out of steam. Many will rest in a well-defined base until the 50-day moving average eventually catches up. If a stock has made a huge advance and trades well above these averages, there's a chance that the stock could fall substantially until it meets with its rising 50-day moving average or 10-week moving average. I prefer the 10-week moving average on the weekly chart versus the 50-day moving average on the daily chart, but either one of these provides a great level of protection from a risk-reward perspective. Buying either of these averages rising into a solid base is usually a recipe for a great low-risk trade. You want the safety net. You want to have the safety net of a base in combination with a strong moving average to greatly diminish risk. So if you look at AMD when it moves from around about $6 to $16 or so, look at the multiple times it bounced off its 50-day moving average. So here you get this shakeout demand tail, perfect shakeout demand tail, which basically look like hammer candlesticks here, undercuts it for a day and then recovers the next day. And a lot of people kind of exit their positions around the 50-day moving average, have their stop losses there. So here on this day, it looks absolutely terrible, the chart, and then it reverses the next day. That's kind of the point of it, right? The stock is trying to go higher with the least amount of people on board. ACS, this is another example of 50-day moving average bounces. This is one of the best performing UK stocks over the last 15 years or so. So see here, it's the purple line. It doesn't bounce perfectly off it every time, but you can see how well it gets defended when the stock starts trending. Bounce in here, in here, in here. Look at the multiple bounces coming through along the way. Not perfectly to the kind of like penny every time. It's just an area to be on the lookout for supportive action. Tesla. Many traders will place their stop losses at the 50-day moving average. In order to have the fewest number of passengers on the train, it is the job of the market maker and the institutions to push the stock below the 50-day moving average, 10-week moving average, to get traders out of their positions. For this reason, it is common to see a strong stock trade 5 to 10% below its 50-day moving average for several days before it resumes its uptrend. If your stock trades below the 50-day moving average for more than a week or two, it could very well be a dud. So that is something to be on the lookout for. So Tesla builds a huge base, starts coming out on volume. The volume starts coming through a couple of weeks later, but look at this causality here. Huge causality, starts building higher lows, tightening from left to right, breaks out support on the 10-week, big shakeout demand tail, and then it starts losing its 10-week moving average in the black line in there. So it's how it's acting around those moving averages. Qualcomm again. Qualcomm, another example of a stock coming out of a large base and riding its 10-week moving average. So see how it generally builds this huge base, starts tightening up. As it starts breaking out, note the volume, note the 52-week highs coming through on the relative strength line, and then see the multiple times the stock was supported on the 10-week. In here, and then this clear change of character. Look how the bar opens on the high of the week, basically closes on the low of the week, just slices through the black line being the 10-week here on increased volume coming through as well. Like, that's a real change of character relative to how the stock's been acting during this uptrend, where it ran from about $4.5, $5 up to over $70. Not bad, right? This is Apple. Most big long-term winners eventually visit their longer-term moving average, such as the 200-day, 20-week moving average or 30-week moving average. Investing in shorter-term movers, we usually won't be looking for such situations, but if you find yourself in a long-term play, a visit to these moving averages can be an excellent low-risk place to enter or add to a position. So this is Apple, and what have we got? Around about 10 years worth of price data. So does it bounce every time? I'm using the red arrows to point to when Apple found support of action around its 200-day moving average. That's going to be the red one. So you can see it in here, nearly in here, in here, in here, in here, in here, and there's several times where it held nearly to the penny, like in here or nearly to the dollar. In here, in here, in here, certainly in here. This was the flash crash in 2010. In here, kind of undercuts, reclaims. So it's not always like perfectly to the penny or the dollar. Okay, it's just an area to be looking for, but also to be aware of decisive breaks through those moving averages. So like with all these moving averages, it's important to apply some common sense. How is the stock acting? What are you seeing from a price and volume perspective as the stock is approaching that level or around that level? How quickly does it then recover? So on and so forth. So position sizing. Position sizing and diversification are entirely dependent upon your risk profile and skill set. This is a topic I can't give you much advice about. To determine your risk profile, you need to take into consideration your tolerance for risk, your age, your goals, your personality, your future financial obligations, and the list goes on. I've been an advocate of the Kelly criterion in terms of determining my own position size. The Kelly formula determines your position size in proportion to the extent of your edge. If you're trading full Kelly, like you are like Viking raid kind of thing, if you understand what I'm saying. Some people go like half Kelly or a quarter Kelly or something like that. So I'm not going to teach you about the Kelly criterion here. You can go and learn about that. There's a fairly good book on the subject. I'm sure there's some good YouTube videos as well, but just be aware, Kelly criterion in terms of position sizing, ridiculously aggressive. There have been times when I have taken a massive, which Jesse is then going on here, there have been times when I have taken a massive multi-million-dollar positions in single stocks when I perceived that there was a massive disconnect between a stock's price and its value. In such times, I would have 90% or more of my net worth in one or two stocks that offered massive potential reward with very limited risk. I do not recommend such a concentrated portfolio for most investors. Ultimately, my portfolio concentration in any one particular stock is dependent on 1. Whether or not there are other stocks available with similar risk versus reward characteristics. How much capital I have to play with. Large capital base equals less individual exposure on a percentage basis. The state of the market. Where are we in the market cycle? So i.e. is the market potentially just coming out of a 2 or 3 year bear market? Or is it potentially 3 or 4 years into a bull market? That's going to play an important consideration. The extent of my edge, the probability and potential upside versus probability and potential downside of the stock in question, risk to reward. Warren Buffett has said that we should invest as if we only will own 20 stocks over the course of our entire lifetimes. Although a bit extreme, this has been the mantra I've tried to live by during my investment career. Don't focus on the general market. Once everything sets up in your favor, don't spend time worrying about the general market. I have a friend who constantly speculated about market direction. S&P 12 in terms of 1250 before 1300, S&P 1400, then 1300, then 1450 before the crash, or the current market exactly parallels how it was in 1997. Thus we are going 40% higher from here, and all of these statements could be in the course of a week. The problem is that such beliefs about the overall market constantly shakes us out of our best stocks. I know several investors who spend 90% of their time trying to predict the market and 10% of their time trying to find winning stocks. The ratio needs to be more like 3% market and 97% winning stocks. I plead with you, do not spend time worrying about the general market. Let your super stocks do the talking. And I've just shown you here is the history of the Dow Jones. The market goes up, the market goes sideways, the market goes up, down, sideways. It is what it is, right? Focus on the super stocks and then try and be there in very advantageous moments in time, both in terms of the super stocks and also market. PHM, let your winners run. After screening for your stock, determining a price target, waiting for the proper buy point, determining your position size, and ultimately jumping into the shark-infested waters, it is imperative that you let your winning stocks run. I can't stress this point enough. Investing is never as easy as it sounds. Since a majority of your stocks will most likely prove to be small losses, you must let your few winners really run wild. There is absolutely no way to win big over the long run if you don't let your best stocks appreciate significantly. So here is PHM. What do you notice about the size of the base? It's a huge bloody base, see? And then it starts tightening. You could look at this as a big cup and handle type pattern as well, but it gets really tight. Look how the volume dries up. Look at the 52-week highs coming through in the base. Then the stock breaks out on huge volume, and before closing below, its 10-week moving average goes up 600%. Get the big ones right. Really important. Control. So on trading mistakes, I took a several $1 million hit within a matter of days. Millions that I worked so hard to accumulate had simply vanished in the blink of an eye. I committed a series of fatal mistakes. Over leverage, used lies in options, catching falling knives, trading in the general market, trading without stop losses. The list goes on. It's a really good book. You can go and read more about it. Quotes. I'm just going to read you a couple that I've highlighted in orange. I now utilize an approach based on maximizing gains within the confines of constant risk reduction and well-defined risk to reward. When a stock's pattern starts breaking down for whatever reason, take a step back and ask yourself if on that day you would enter the stock for the very first time. If the answer is no, it is probably best to act decisively and cut your loss immediately. Let me go here. This is a good quote. The game is 100% about low risk entries in combination with a high likelihood of price appreciation. Let me just give you an example here. So this is what Jesse talks about in the book, and I've tried to give you a schematic here that I will then explain. So I only take substantial positions in stocks that I believe have 100% plus potential. Once I determine that a stock can move 100, 200 or 300% or more, I then want to determine the downside. If an $11 stock breaks out of a $10 supported base, so that's what I've tried to draw down here, the potential downside would only be $1 or 9%, because there's no reason to own the stock below its base of support. If the company just reported earnings per share of 35 cents based on a price earnings multiple of 20, you determine that your target price is $28. 35 cents times 4 quarters equals $1.40 in terms of annualized earnings per share times 20p equals $28. In this instance, the odds are stacked heavily in your favor. $17 upside and $1 downside, and almost 17-to-1 reward to risk ratio. On a percentage basis, you're looking at 255% upside and 9% downside, as the best Momo stocks can trade up to 30 or 40 annualized PE PEs during their run, you could be looking at a 510% potential upside versus 9% downside at the current earnings per share run rate. When such little risk is present for such a comparatively large reward, you have to force yourself to get off the bench, take a swing at the fat pitch, and ride it as high as you possibly can. With respect to the downside, always determine in advance what you are willing to risk. Once this level is determined, you must have a predetermined mental or physical stop loss order in place with your broker to limit your losses. So here, this is just a kind of a schematic, obviously, but the stock rides up to what Jesse was saying here at about $28, and obviously it ain't going to go there in a straight line. It's probably going to build, kind of trend up, build bases, trend up, build bases, right? Stair-stepping pattern. And we could imagine that this blue line here is the 10-week moving average or something like that, right? But see here, the stock is basically consolidating in this instance here between $11 and $10. So what Jesse's saying is, well, he could be buying the breakout here, or potentially it's really tight and it's coming out. Maybe it's a monster earnings report, but he's buying at $11 here, and then he could place his stop loss here, because this is where the supportive action is. So he's using both fundamentals and also technicals, but really then the technicals to help define the risk as well. So in this instance here, his risk could be $1, i.e. he's buying it at, let's say, $11 and his stop loss is placed at $10. So his risk is $1, but he thinks there's a realistic chance that he could have 17-1 reward to risk. So he could be looking for $17 of upside with $1 risk associated. That's really, really good. So again, not every setup is created equal. It's really trying to find those asymmetric risk versus reward opportunities. Now, mitigate. So in recent videos, you may have seen me do like some risk mitigation where we're like selling a third here, bumping stop losses up and all that. Jesse doesn't talk about that in the book, so I'm not going to talk about it. But I think Jesse's risk mitigation comes in the form of his fundamental research and studying the technical action of the stock on the chart before his entries to mitigate risk as best he can before he invests his capital. So he's kind of like mitigating risk in other ways in terms of fundamental research, being patient, waiting for the setup, waiting for favorable risk versus reward, and all of that good stuff. Now let's get into some of the sexy stuff, which is optimizing profits. So I'm just going to read you. You can pause the video. You can read these quotes out if you you can read them out, or you could just read them. It's really, really up to you. But I'm just going to read you a couple of the ones that I've highlighted to stress some key points. One big gainer literally makes up for dozens of the inevitable losers. The best times to exit are always at sentiment extremes, when your ego at least wants you to sell. I have found that technical sell signals are vastly more important than fundamental sell criteria. The simple truth is that technicals will tell you to get out well before fundamental reasons present themselves. So here we go. The 16 super laws of selling technical risk. Now, some of these charts are going to be a little bit text heavy, but that's why I've included the charts, so you can look at the charts and just kind of analyze those while I'm reading to you. So number one, sell time and large deviation from the 10-week moving average or magic line. On your stock's initial breakout from its base, it really doesn't matter too much how far it trades above key support levels. If a stock doubles out of a strong long-term base on its earnings announcement, it will likely be 100% above key short-term and longer-term moving average. This would not be an automatic sell signal, as this is the first week of the stock's advance. Alternatively, if your chosen stock trades 60% or more above its magic line, possibly 10-week moving average or 50-day moving average, any time after the first 6 weeks of its initial breakout, it may be time to take some chips off the table and wait until support catches up, being moving averages. The biggest gainers always visit their magic line several times during their advances. If your stock is 100% above its magic line, one of two things is bound to happen. One, your stock is going to completely fall apart, or two, it will wait patiently for a couple of months until things settle down and the magic line plays catch up. I have found that after surging off their magic lines, the strongest stocks hit an intermediate term peak no later than 7 to 10 weeks later. If your stock hits its 10-week moving average support and surges higher for 7 to 10 weeks without testing its magic line, it could be a great place to exit. So if you look at Monster Beverage here, I showed you this on the monthly chart a little bit earlier from 2003 to 2006. If you look here, the black line is going to be the most important one to look at. When the stock breaks out of a base, so let's say like this one here, the stock bases and then it breaks out, pulls back in, so bounces off the 10, off the 10, off the 10, off the 10, off the 10. So what Jesse's saying is if you think it's starting to get extended, it's likely to then revisit its 10-week moving average. So here's quite a good example, right? Builds a multi-month base coming through here, breaks out, starts getting extended from the 10 week on a short-term basis. Now I'm going to teach you a little bit later on lower the bar, lower the bar, lower the bar, lower the bar, which I just think on a consistent basis for me is the best way, both in terms of financial gain, but also in terms of controlling emotions as well. So if I start thinking the stock gets extended from key moving averages, I trade much more primarily on daily charts instead of weekly charts, but it's very applicable for weekly charts. So if on this week here you're like, oh crikey, this is so extended, well, you could choke off all or part of your position. It really depends. Each trade is unique, but going lower the bar, lower the bar, lower the bar, lower the bar, lower the bar with your stop loss, even up here, lower the bar, lower the bar, lower the bar, lower the bar. It's really effective. Up here, if you think this is extended, lower the bar, lower the bar, lower the bar. It's really, really good. GHM. Sell after a 9 to 15th month advance from a breakout. Many of the biggest winners start collapsing between 9 and 15 months after their initial breakout. The point is to be extremely cautious when holding a stock beyond the 9-month mark. So it doesn't mean just sell because you're at the 9-month mark. It just means look out for some of the kind of violations. Look for when a stock is acting differently. So this is GHM. What you notice? Breaks out of a huge base. Look at the tightness coming through. This is on the monthly chart, but look at the tightness. This is ridiculous. Then goes on a big 16th month run, pulls back in, consolidates. Look at the tightness, look at the volume, dries up, breaks out on huge volume, then goes on a 15-month run here. And again, even on the monthly chart, if you think it's extended, lower the bar, lower the bar, lower the bar, lower the bar. It's really, really, really effective. Sell a declining or flattening moving average after a long advance. And if you think about kind of William O'Neill and his base count, so Jesse is very familiar and recommends William O'Neill's How to Make Money in Stocks book. William O'Neill said 4th and 5th stage bases are very, very failure prone. Again, the move gets longer than tooth. It gets a little bit obvious. The smart money that was buying earlier on as it was coming out in the phase 1 base, as it was coming out in the phase 1 base, institutional trend followers jumping on it early as it was coming out and improving fundamentals, they're then looking for an area to exit their positions. So that's why what Jesse's saying here about long advances, 9 months, 15 months, be aware of it. Be aware of base counts as well. The strongest stocks have magic lines that steadily climb for the first 6 months or so of an advance. During this time, I'll just read this one out to you. So you see how early on it's got a really high angle of attack here, and then as it starts getting a little bit longer into, see how it starts flattening and starts rolling here. So again, kind of flattening, rolling over moving averages, but again, it's then the violations. Here with Netflix on the weekly chart, first clear break of, this is actually the 19-week moving average, which was its magic line. See how it bounces perfectly, and then slices through it. The stock is then acting differently, so be aware of it. 4. Sell 4 surges off the magic line. The strongest stocks will surge off their magic line only a handful of times during their advance. I have found that many stocks turn down after their 4th or 5th surge off the magic line. At the tail end, a fading stock will no longer make a strong move off its magic line, but instead it will trade erratically above and below its line for several weeks in a row. So if you take a look here, this is TZU. So here you get the first surge, pulls back in, finds support on the 10-week. Second surge, pulls in, finds support on the 10-week, tightens up in there. This is a really nice flag type pattern. Third surge, pulls back in. Fourth surge. Again, think about that as the O'Neill point of 4th and 5th stage bases become very, very failure prone, and then you have your decisive break hit, and then the stock just collapses from about $110, and this stock kept going down and down and down. But you can see how quickly these stocks can fall apart. So what's the old saying? They take the stairs up and the lift down. Very, very, very true. This is silver futures. So sell a parabolic run at the end of a longer term bull advance. Individual stocks and also silver futures and markets tend to have larger buying climaxes that mark the end of their run in very dramatic fashion. A good rule of thumb is the longer the bull trend, the larger the vertical climax move. The final day and final week of this type of move most often display the largest trading range in terms of the range that price is trading, with the highest volume of the entire longer term advance. I would most certainly sell a stock that is trading well above its upper trend line if the stock had a huge daily price move, not necessarily a huge percentage move, that was much larger than the previous price moves. It was well above its 5-day moving average. If I miss 1 and 2, I would sell the stock once it broke its 5-day moving average. This is silver futures on the weekly chart. This is what an extended kind of parabolic move looks like. Do you see the acceleration here? See how just certainly the last 4 weeks, 1, 2, 3, 4. See how it's doing this here? And this here, it was then eclipsed by the volume that then followed on the subsequent week, but this was the largest volume ever in silver futures. So it's, where is the context? Like, where are you seeing the largest volume ever? Are you seeing it when it's basically just gone parabolic, or are you seeing it as it's coming out of a phase 1 base? So it's the context. And I know I keep harping on about it, but I do think, like, look at it. Lower the bar, lower the bar, lower the bar, lower the bar, lower the bar. It's really effective. I'll show you some things. Here you go. So additional slide on parabolic run. So this isn't in the book. This is just me putting my own twist in here because I think it may or may not be useful. decide for yourself. My experience is extended stocks can become more extended. Often, the end of the move can be the biggest part of the move in the shortest period. Adjusting my stop loss to lower the bar on the daily and or weekly chart is what I found to be the most consistent, unemotional approach. Black lines indicated price level stop losses would have been triggered following this approach. It's a method I got from Nicholas Davis. Let my stop loss decide. So if you take a look at Tesla on the weekly chart, it's had around about 4 or so at least parabolic runs over the last couple of years, right? Before it kind of entered, it got absolutely slammed in a bear market in growth stocks in particular. But you see here, see how parabolic it goes on the weekly chart. So imagine here, if you're like, imagine on this week here, you're like, well, it's a supply shoot, it's a topping tail, it's a shooting star, whatever you think. Like on this week here, you're like, it's extended, I'm getting out of it. Well, then it just keeps going and going and going. So again, I just think Davis's point, let your stop loss decide. Lower the bar. So I imagine this black line here, it's here. Lower the bar, 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 lower the bar. Really effective. Imagine here, if you're like, back-to-back really strong weeks, lower the bar, lower the bar. This is the 10-week, it's extended from it. Lower the bar, lower the bar, lower the bar. Imagine here. Imagine if on this week here, you're like, those things stupidly extend. Don't want to lower the bar, lower the bar, lower the bar, lower the bar, lower the bar. You're taking up here. Imagine here, if on this week or this week, you're like, I'm getting out of it, I'm getting, lower the bar, lower the bar, lower the bar. Calm it down. Works for me, may not work for you. You decide that. GameStop. Imagine this one as well, right? Now we're on the daily chart instead of the weekly chart. So GameStop breaks out of this base, has a bit of VCP look to it, 1 contraction, 2 contraction, 3 contraction. Look at the tightness, look at the volume drive. Imagine if on this day here, on the initial breakout day here, when there's huge volume coming for you, like, I'm out of this. I'm a genius. I bought it at $5 and I've just sold it at $8. So you took $3 out of the move and it went up $70. Like, wait, what? Like, what's the point? Like, get the big ones right. So imagine if on this day here, you're like, this thing is so extended, I'm out. Imagine on this day here, if you're like, this thing is so extended, I'm out. Imagine on this day here, if you're like, this thing is so extended, I'm out. Lower the day, lower the day, lower the day, lower the day. Calm it all down. ACM. I'm sure many of you will be familiar with this as well. So it breaks out of this big flag type base, and imagine if on this day here you're like, I'm out of this thing, this is so extended, and you bought it here perfectly at like $8.50 on the breakout, or maybe you bought it down here, or maybe you bought it down here when it was really tight, or maybe you bought it around the 10 EMA or something like this, right? And then here you were like, this thing it's so extended. Again, lower the bar, 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 lower the bar. It's really, really, really effective. Go have a look for yourself. Oh, I got one more for you as well. Imagine this one here. So anyway, I'll come to it in a minute. Sell large price ranges. Let's say that your stock has traded 80% higher over the past 3 weeks. As it trended higher, its daily range is 50 cents on average. During the stock's advance, the largest daily price range was $1. All of a sudden, your stock moves up $2.25 in one day, which happens to be 4.5 times its daily average range. After an extended trend, this is often a sign of short or intermediate term buying capitulation. Buyers who miss the advance are piling into the stock all at once, fearing they will miss the move. On such a buying climax, volume is almost always well above average. After such price action, there may not be anyone left to buy. So again, it's context. This is the thing about combining the fundamentals, combining it with the technicals. Where are you seeing this action? That's why the charts are so important. So what if you had bought the stock, let's say, you had got involved in the stock, I don't know, maybe here when it kind of tightened up, maybe you're thinking, oh, it's a cup and handle type pattern. I mean, it's below the 200, so maybe it's not great. But imagine you're in the stock here, and then on this day here, you're like, I'm out of this thing. Yeah, but it's acting like really well. Look at the volume coming through. It gaps, and then on the gap, look, it gaps up and it opens on the lower the bar. It opens on the lower the bar and then pushes up and closes near the higher the bar. So imagine if you just went, I'm going to let my stop loss decide. Lower the bar, 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 lower the bar. Maybe you're taken out here. If you're not and you gave it a slight bit of room, then you'll lower the bar up here. You're knocked out pretty much near the top. Maybe on all your position, maybe on part of your position. You decide, right? 7, sell a falling knife below the lower trend channel. Now, again, I think these are pretty subjective. It can differ greatly whether you're on blog scaling, whether you're on arithmetic scaling. But here, it's basically, do you see all the red bars? Look how orderly the stock is moving here. So it builds this base. Now, I think this is an oil and gas stock, so it's ridiculously choppy anyway. But you see how it's building this base here, and certainly this kind of pullback here. Okay, it's pretty orderly, but then look how volatile the price action gets. Volatile price action on high levels of relative volume is a sign of distribution, and it's the context. Where are you seeing it? Like, where are you seeing it? It's here. The stock's just broken out of a big base. It's in the context of a long-term uptrend. And then look, it's just choppy. It's all over the place. This is horrendous price action. And then it just slices through this lower trend line. And look at the volume coming through. This is horrendous. Sell volatility when a stock is extended. So this is DocuSign. So as our stocks advance, we want to see them forming boring low volume bases in very tight price ranges. If our stock is well above its key moving averages and volatility and volume begin to increase, you must take notice. Especially watch for an extended stock whose average daily volume range expands on heavy volume while its closing prices remain in a tight range. This type of erratic price action is routinely seen at tops and bottoms. So I'm going to talk about this top here, but this was the bottom here. Now, DocuSign was one of the beneficiaries, if you can say that, of kind of COVID and the stay-at-home thing, right? So as it's pulling down, it actually holds its 200-day moving average, and look at all the 52-week highs. The market never misses the best opportunities. There's 52-week highs all over the place as the stock's pulling down, showing a lot of relative strength versus the index being the S&P 500. But look at the volatility coming down. So oftentimes you can see volatility at bottom of a stock space where large operators are stepping up. They're trying to scare out weak hands because price action looks terrible. The VIX is doing this. The world is going to end, right? But large operators are in here accumulating. Then up here, they're distributing. So again, it's looking at high volatility areas and then applying some common sense. The stock has run from about $80 up to $280, and then it's just after the earnings reaction. So you get huge volume. So with a stock like DocuSign, which is a much bigger company, it's a large cap, you would be expecting large operators to be playing there. And then look, it's huge kind of climactic volume coming through and the price action. And then on the back of the earnings report, it's not then going up. It's just crashing back down on the volume. That was institutions distributing. And this up here could have been like a massive earnings beat. The fact it's green means there would have been a beat on at least the earnings side, and if not the revenue side of things as well. So this is where it's potentially being pumped on mainstream media, mass media, as Jesse refers to it. So giddy kind of retail traders are getting in. They're going, oh, earnings are up. Oh, great story about this. Yeah, COVID stay-at-home stocks beneficiary. The smart money have already made their money. They're now looking to get out of DocuSign and then crash. I think from here it went down 70-80%, something like that, over the next 18 months or so. Qualcomm, sell a weekly exhaustion gap. If your stock has been trending higher for several months and gaps up to a new weekly high, this might be a signal to exit. Gaps are great when they come off solid bases, but gaps well into uptrends are the kiss of death. So if you look at Qualcomm here, right, trending up really nice, really orderly. Look at the tight candlesticks. Look at the volume drying up as well. This was like a real leader in the late 90s, but these tight candlesticks, orderly price action, 52-week highs all over the place, blockbuster fundamentals is a sign that institutions are in there. They're supporting the stock. This is nearly as perfect high tight flag that you will see. Look how the volume dries up, 52-week highs. But here, do you start to see the kind of real climactic price action? So this is a gap up. Well, it's a gap up reversal, but Jesse refers to it as an exhaustion gap as well. So the prior closes here, the weekly chart, it gaps up, opens at $100. This will be split adjusted, I believe, but opens at $100, very round psychological number if it's not split adjusted, and then sells down here, and look at the volume coming through. So it's context. The stock here has run from $10 up to $100. It's a 10 bagger. Then where are you seeing this climactic volume? Again, institutions are looking for a place to offload into goody retail traders. The 16 super laws are selling, couple more. So sell at your stop loss, sell $25 to $30. Jesse has noticed that many of his biggest winners have actually topped out around $25 to $30. Could do your own research on that. Sell a mistake, sell 3 higher highs, sell if peers are weakening. So Jesse Livermore would call that tandem trading. You want to be aware of the brother and sister stocks in the group. Are they weakening or not? This one here. So several stocks mentioned from the sell to $25 to, let's just say, $30 section, and I'm guessing where Jesse entered. You can see some of the quotes from the book here as well are pretty nice. But you see this light and tight near the 10-week, and then where does it top out? $27. Interesting. This is JSDA. So here, nice light and tight. Where does it top out? Around about $30, $29. TRT, light and tight, tops out around about $20, $24, $25. Interesting. Lockham, see how it gets light and tight in here, then this one tops out. I think this may be like split adjusted, which is why it's a little bit lower, but see the tightness that comes through, see how the volume dries up. That is nice to see. Here's one more as well. So this is the XEP. So see how the stock builds a really nice base, and it gets kind of light and tight onto the 10-week moving average, clustering of key moving averages there, and then do you see here how the volume dries up, and then the stock goes out like that. Nice. This one here is eBay. So 15, sell on a breach of the upper trend line. After a lengthy advance, some stocks will advance up to that upper trend line. This was also an O'Neill point in how to make money in stocks about breaches above upper trend lines. So there's a couple of videos on the channel about that if you're interested. And instead of bouncing lower as they have in the past, they may trade above it for the first time. This is a tricky scenario because it can either mark the end of an advance or mark the beginning of a large parabolic move higher. Much of it depends on how overbought the stock is when it hits the upper trend line. My rule of thumb is to closely watch a stock trading above its trend line for any signs of weakness. Since you don't want to miss out on the possibility of a big parabolic advance, remember that happens at the end invariably, I would look to sell on any close back below the upper trend line. Remember what I mentioned earlier about lower the bar, lower the candle for an effective sell technique also when dealing with extended stock. So here, this is eBay, we looked at this chart earlier, builds this nice base, comes out, and then you have this trend channel, okay? So you connect, it needs to have at least 3 touch points. You have 1 touch point, 2 touch points, 3 touch points here. Goes briefly above it here, but certainly here, right? It's now extended, it's trading above it. So what if you just went, I'm gonna let my stop losses slide, lower the bar on all or part of your position? Up to you. You decide. Go and study hundreds, thousands of these. See how they move. See what are the best sell rules for you. But looking at extended trend channels, or when a stock is extended from its trend channel and upper trend line, effective key. And you can see here it's also extended short term just visually from its 10-week moving average being the black line in there. This is Tesla. So the final one of the 16 super laws for selling. Sell upper Bollinger Band. In terms of breakouts above upper Bollinger Bands. After a stock trades outside of its upper Bollinger Band, wait for the first goes back within the band for a sell signal. So here with Tesla, it breaks out. This was actually its inclusion into the S&P 500. Then it breaks out, starts trending higher, nice tickety boo. Then here it's extended from its Bollinger Band. So see how it is out here, and then it's the first closer back within the band. Jesse is saying can also act as a sell rule. So plenty of different sell rules there to be thinking about. Some other ones, the top 5 super laws of selling fundamental risk, and then some second tier sell signals as well. So sell at your price target or when the risk reward is no longer favorable. Sell secondary offerings / private placements without hesitation. Sell the end of a sequential earnings ramp. Sell any stock split. Sell massive insider selling. If you want to go and then read a little bit more, there's little paragraphs below these in the book. Go and buy the book. Second tier sell signals, sell headlines, sell messages bore euphoria, sell expansion, sell if you become a genius, sell confusing earnings reports, sell tax loss reversals, sell pre-earnings euphoria, sell the fluff, buy the rumor and sell the news, sell stock advertisements, sell strategic alternatives. Mindset, these are quite good things. Top 16 things you must do differently to achieve massive success. Relentlessly study the art of selling. Focus on weekly and monthly charts. Bi-weekly boredom, so buy light and tight, preferably around magic lines. Become one with the magic line. Focus exclusively on small cap stocks. Wait until everything lined up. Don't invest like mutual funds. Invest on an island, so i.e. tune out all the noise. Become a swing trader. Buy the $3 to $15 sweet spot for kind of initial breakouts. Buy individual stocks, not mainstream ETFs or mutual funds. Stop investing in what you know. Become obsessed with charts. Become a sentiment stud. Master emotions of yourself and the charts. Sell as your stock rises. Divorce yourself from mass media and claim your independence today. Now, this is the last slide. So just a little bit on the mindset side of things. I really like the book. I would highly recommend the book. I really like it, and it's a really good book, and it's a book that every time you go back to it, you seem to learn a little bit more. You go a little bit deeper. There is a lot of knowledge, a lot of information, a lot of wisdom, a lot of golden nuggets within the book. So I don't know, I've probably read it 5 or 10 times now, and every time I read it, and this for this YouTube video is probably like the most in-depth I went in the book to really study it, pick out different parts I wanted to cover in the video, and I got a lot out of it. Really like it. Really like kind of Jesse's approach to it as well, how he explains things. The mass media tries everything in its vast arsenal to turn you into a pessimist. Do you know of any self-made multimillionaires or billionaires who are pessimists? And I will leave you with that. So thank you very much for watching, guys. I appreciate your support on these videos. If you've liked it, then please do like the video, subscribe if you haven't subscribed to the channel. If you have any questions about the video or any trading questions, then just let me know down below. If you have any requests that you'd like to see me do future videos on, also let me know in the comments below. So thank you very much for watching, and I will see you in a future video.